We are now looking at the situation when a recipient, so the shareholder, receives a dividend or return of capital. Now this is a slide which is very similar to something you might have seen previously under dividends tax. It's just a reminder of it. Okay, so remember now, just build it up from the start again. A company makes a payment to its shareholder, a distribution. That distribution can be one of two things: a dividend or contributed tax capital. The other word for contributed tax capital, which you'll see, which we use here a lot, is return of capital. So, in other words, if the directors, remember the directors make the decision to pay this out. If the directors make the decision to pay out contributed tax capital, they are making the decision to return your capital to you. That's why they use the two terms there. Okay. Now, we are looking at it now from the shareholder's perspective. So the shareholder is going to do this calculation where it says it received a dividend or it received contributed tax capital. And what do we do with that? That's the question we have to ask now. So now, dividend, return of capital. So that's the first thing. The two different situations you can get. Then, this shareholder over here, why does it have shares in the company? It's either a share dealer or an investor, which means it holds it for capital purposes. So you either hold it for a scheme of profit making or for capital. Scheme of profit making or capital. There you go. So you can see both of them are split. So now see, when it is a dividend, this is the easy one. Whether you have it as an investment or as a share dealer, the dividend portion is gross income and it is exempt. Okay, so let me just do the following here a little bit. Okay, so for now, remember, if a South African company pays a dividend to another South African company, there is no dividends tax per section 64F. Alright, no dividends tax. Now, assume that's the case here. We just want to eliminate dividends tax. I don't want to have that to think of right now. I just want to make it more simple just so we can get down to the basics. Now, this company gives out a distribution of 100,000 rands. 80,000 of that is a dividend, and 20,000 of that is return of capital. Okay, so now let's look at the shareholder. The shareholder, for the dividend portion, that 80,000 will include the 80,000 rands, and it will be exempt. And I want you to see here, for investor plus a share dealer, this is what will happen. So we're looking at this. The dividend portion is included and it is exempt. Doesn't matter if you're an investor or a share dealer. Okay, now let's look at the contributed tax capital portion at 20,000. If you are a share dealer, okay, if you're a share dealer, that contributed tax capital, the 20,000 that you receive, is an amount that you received in the scheme of profit making. So it is gross income. You include that 20,000 rands. The exemption, no exemption. There's no exemption for contributed tax capital in the Act. Find it, show it, doesn't exist. It's only for dividends. So that's what we're seeing over here. Then, if you are not a shareholder, share dealer, but you're now an investor, then you will not include the amount in that way. And there's obviously not an exemption. What you'll do is you will apply a section called paragraph 76B. So make sure you see now, this applies if you are holding shares as a capital amount and it's for the return of capital. What does paragraph 76B tell us to do? Okay, we're going to talk at that now. So we're climbing into that now. So we're looking at, I'm reminding you, you receive a return of capital as an investor. So first thing I want to talk about is what is a return of capital, just to show you from the Act in section 1. says a return of capital means any amount transferred by a company that is a resident for the benefit or on behalf of a person in respect of any share that results in the reduction of contributed tax capital, whether that is by way of a distribution or as consideration for the acquisition of a share, so share buyback. Okay, so let's quickly talk about that. You have shares. X Limited announces that it will buy back 10% of its shares. It will pay 5 rands per share, which consists of 2 rands dividend and 3 rands contributed tax capital. So they're saying that when you buy back your shares, that is also return of capital, the CTC part. We know the dividend's also a dividend part, if you look at the definition of a dividend. So that's what they're referring to there. But it does not include shares in the company, so this is capitalization issue. So if you issue shares to someone, there's no return of capital, or an acquisition by the company of its own securities in terms of JSE. So listed company share buyback is the next one. So if X Limited here was a listed company, remember limited doesn't mean it's listed, guys, it's just a public company. All listed companies are limited, but not all limited companies are listed. Very important. Students make that mistake all the time, and that shows a severe lack of understanding how a Companies Act works and how companies in general work. You can't make that mistake, guys, not as a postgraduate student, as a CTA student. If you make that mistake, can't pass. Shouldn't pass. I don't want you to be a CA along with me. Right, so if X Limited is a listed company, then this over here, the 3 rand contributed tax capital, cannot be contributed tax capital. It also can't be a dividend if you look back to it. So that's a little bit of an exception to the rule. Not as common to see though. But what were we getting to? We were saying if you receive a return of capital as an investor, we have to apply paragraph 76B. So what does paragraph 76B tell us to do? Paragraph 76B applies then. If you hold the shares for capital purposes, okay, so I'm just going to take you back. This is why it's capital purposes, it's an investment, and you receive a return of capital. Okay, so that's why we're looking at paragraph 76B. So paragraph 76B says, the point behind paragraph 76B is that you will reduce the base cost of the shares that you hold by the contributed tax capital amount. So that means at a later stage when you sell the shares, there will be a greater capital gain. This also means that there's no capital gain at the time when you receive the contributed tax capital. So let me explain to you. Let's say you bought shares that were worth 10 rands a share. And now the company is paying you a contributed tax capital amount and you're an investor of 3 rands. It means that you will make a new base cost of 7 rands. So if you sell this now later for, let's say, 18 rands, your base cost will not be 10. It will be 7. So you'll make a capital gain of 11. Okay, so very important. If you hold shares as an investor and the company pays back a return of capital, you make the base cost of your shares less. So this is my CGT column, this is my rands column. When this happens, nothing gets included here, guys. This is just a calculation that we perform. Sorry, this over here. This is just a calculation that we perform. When we then later sell the shares, it will go into our correct portion. But now, that's what I said here is the most important. So let me just explain it. Let me just do the following again. Okay, quick example. Mr. A purchased 100 shares in X Limited at a cost of 10 rands per share. Mr. A holds the shares as investment. 1 year later, the directors declare dividend of 8 rands per share. Oh, sorry. Let me all say. 1 year later, the directors declare a distribution of 8 rands per share, which consists of let's say, sorry guys, 8 rands per share, and it consists of 5 rands dividend and 3 rands contributed tax capital. So that gives us the 8 rands. So I'm just going to go for the example. Mr. A purchased 100 shares in X Limited at a cost of 10 rands per share. Okay, so 10 rands times 100 equals 1,000 rands. Mr. A holds the shares as investment. 1 year later, the directors declare a distribution of 8 rands per share, which consists of 5 rands dividend and 3 rands contributed tax capital. So, what is this Mr. A going to do? When we do his tax calculation now, he's going to say dividend received. He has 100 shares and he receives 5 rands dividend per share, so 500 rands. That full amount is exempt. Okay, it's taking it up. He received a dividend as an investment, it's gross income, and it's exempt. What happens to the return of capital? It's an investment, we have to apply paragraph 76B. Okay, so now, we've done the dividend part, now it's the return of capital. Paragraph 76B. This one says the base cost. What is the base cost of these shares? It's 100 shares, 10 rands a share, so 1,000 rands. So the base cost is 1,000 rands. Here's my CGT column, guys. Please see I haven't done anything there yet. Then we say, less our return of capital. They gave us 3 rands per share as return of capital. So 100 times 3 is 300 rands. So this makes our new base cost. This is our new base cost, 700 rands. Please note, there's still nothing in CPT. If now a year later I sell it, right? Proceeds, I'm just thumb-sucking amounts. Let's say I sell it for 2,000 rands. My base cost will not be 1,000 rands. My base cost will be the 700 rands I used, or which I calculated there. So my CGT is 1,300. See here, if it was still 1,000 rands, then my CGT would have only been 1,000 rands. So there's a 300 rands difference. That 300 rands difference over there. So what happens is they don't tax the contributed tax capital when you receive it, they tax it when you sell the shares. That's the idea behind it. Now that what I've just done now, that is the most important part, and that is paragraph 76B2 for shares acquired after 1 October 2001. That's the most important one. That's the one that I expect to see most of the time. For shares which were acquired before 1 October 2001. So guys, these are now very old shares by now. It works a little bit more, it's a little bit different, it's a little bit more challenging. And I don't want you to, when you're looking at paragraph 76B, so make sure now you understand what I'm saying here and you listen carefully. If you are looking at paragraph 76B and you get a little bit confused with paragraph 76B1, that's understandable. But if you're getting confused with paragraph 76B2, it's not understandable at all. It's not acceptable at all. So, make sure that you're not now confusing the two with each other. The most important one, paragraph 76B2, which I just showed you. Okay, what I want you to see is paragraph 76B1 and 2, both of them, you deduct return of capital from base cost. I want you to see that. So that in yellow is the same. This is where the difference is. When the assets were acquired before the 1 October 2001, you need to calculate a new base cost first. Because when we do this calculation, which I just showed you guys, okay, I'm just redoing it quickly. You deduct, sorry, over here. When you do this paragraph 76b, you deduct the return of capital from the base cost. So this base cost over here must be correct. And what do we know about assets acquired before the 1st of October 2001? Their base cost is complicated because it is calculated as the valuation date value plus costs after 1 October 2001. This is all from CGT, your CGT knowledge. So it's a little bit more difficult. So what they say is, if the shares were acquired before the 1st of October 2001 and you receive a return of capital, first you're going to calculate a new base cost. And that will then give you this base cost over here. And then you will deduct the return of capital from it. Okay, so here's paragraph 76b2, the one we just spoke of, the easier one, the most important one, showing you where it is in the Act. Where a return of capital by way of a distribution of cash or an asset in specie is received by a holder in shares, and that is after 1 April 2012. You don't have to worry about before 1 April 2012, it's not on your syllabus. The holder of that shares must reduce the expenditure in respect of the shares by the amount of that cash or the market value of that asset. This reduce the expenditure is reduce the base cost. Remember, the expenditure that you incur in terms of the 8th schedule is base cost. So they're saying, if you receive a return of capital in your holder of shares, you must reduce the base cost. Now guys, they don't talk about investment or share dealer. Can you see? So let me just go back. They're not talking here if it's a share deal or investment. But I said to you, it only applies to investments. Why? Because you need to remember the 8th schedule applies to capital assets. Okay, and it does apply to, yeah, trading stock and those things are considered, but those things have their own rules with the gross income definition. That's why it applies only to investors. Now, paragraph 76b1, this is the more difficult one. So first I want you to see what they do is they tell you how to calculate this new base cost. And then you will deduct that amount. Okay, so where a return of capital is received by a distribution of cash or an asset in specie by a holder of shares, and that share is a pre-valuation date asset. What is valuation date, guys? Remember from your knowledge? 1 October 2001. So they're saying it's before that date. Pre-valuation date. Then they say, for the purposes of determining the date of acquisition of that share and the expenditure in respect of the cost of acquisition of that share. So in other words, this expenditure again, they say that's base cost. Remember, expenditure in the 8th schedule refers to base cost, because that's what it is. So they say, for purpose of determining the base cost, the holder of the shares must be treated as having disposed of the share immediately before the return of capital and having immediately reacquired that share at an expenditure equal to the market value, less any capital gain that would have been determined, and increased by any capital loss that would have been determined. And that must be treated as an amount of expenditure incurred for the purposes of paragraph 21a, which is the base cost. Okay. So, we're still talking about it. What is the goal of paragraph 76b, guys? The goal of paragraph 76b is to do this calculation where you say base cost less return of capital. So what we're looking at now is how do we determine that base cost first, that first amount there. How do we determine that first? And that's what we looked at now. So what do they say you should do? They say you should be treated as if you sold the shares at market value right before you received the return of capital. But important, you do not include this in your capital gains for the year. It's just a calculation that you perform. The base cost is normal. Then you are treated as if you bought those shares back at market value. Remember, you were just treated as if you sold it at market value. Now you treat it as if you bought it back at that market value, less whatever capital gain you calculated here. That gives you the new base cost. It gives you this figure. And then only can you deduct the return of capital from it. Okay, it's a notional calculation, guys. Does not happen in real life. Paragraph 76b(3) then says, where the amount of the return of capital exceeds the expenditure, the base cost, it must be treated as a capital gain that you received. Okay, so let's imagine your base cost is 1,000 rands, but the return of capital that you receive is 1,200 rands. It'll make your base cost null, and that excess of 200 rands, that will be capital gains tax, and that'll go into your CGT column.